AEW are a large global real estate manager, and I think many investors, when they're looking for managers of real estate and other asset classes, look for the combination of the comfort of a large global organisation and also the entrepreneurial spirit that comes from a boutique. AEW is quite unusual, it seems to be, in that regard, in that it's part of the large Natixis group, giving financial stability. And meanwhile, the team itself is a small, nimble, boutique-like team that's able to actually look for interesting opportunities in the real estate world.
This is an interesting strategy focusing on buying smaller than average UK commercial properties. It's primarily a regional focused strategy, and we find that by buying smaller properties with generally shorter than average unexpired lease terms, we feel that we can buy high yielding properties with a sustainable level of high yield and the potential to add value through asset management as well. We have a very strong track record, so we have paid out a high dividend of 2p per share per quarter. The properties also have seen some capital value growth coming through, so growth on net asset value along with a very high income return as well. There's been very little development of properties in the regions, particularly the reasonable quality industrial properties and offices as well. And because there's been very little development, we're finding there's quite a shortage of supply for tenants who want to occupy these types of properties. And obviously where there's a shortage of supply and high demand, you tend to see rental value growth. At the moment, we're leaning more towards favouring the industrial sector, where we're seeing very strong rental growth. We also hold office properties and selectively retail properties. Plus, we have a sector labelled other, and at the moment that includes a cinema, but could include things like car parks and leisure properties and so on. So by spreading our risk across a portfolio of 31 properties, diversification becomes a risk management tool. We've got a very experienced asset management team. We spend a lot of time talking to our tenants and going to visit our properties. And we find a lot of opportunities come up from knowing our tenants well and understanding their businesses too. Bristol was a great opportunity of knowing the market well, using the best-in-class agents to get the most up-to-date information of what was going on in the market, using our investment committee to sign off that decision, and using our internal and external research to really understand the depth of demand in the Bristol market. And that's been really apparent in our purchase of an office building in Queen Square in Bristol. We bought that just under 2 years ago when it was half empty. We have done a very limited refurbishment on some of the vacant suites. We've let all of those vacant suites at values ahead of our estimated rental value.
The only main takeaway for an investor in real estate is if you look at the total returns generated by the asset class over the long term, the majority of the return has always come from income and not capital appreciation. So I think it's advisable for investors looking for a real estate play to focus very much on the income component of those total returns, certainly based on history.
I hope investors would see that we have the ability to add value, to find missed price opportunities, and I hope it would give investors the confidence that with our long track record of outperformance and the wealth of opportunities that we're seeing moving forwards, that we'll be able to continue to find a whole range of interesting properties for this REIT to purchase and continue collecting and delivering a very attractive income stream and adding value through asset management on the way through as well.